In this week's video, we'll review the latest charts, data, and studies to help us answer the question, will peaking inflation allow stocks to hold above the 2022 lows? We'll be moving rapidly, so feel free to use the pause button on your video player. You may remember the first bullet point in the summary slide from last week's video was that stocks may be more vulnerable than they appear. We'll expand on that concept in this week's video. Last week we talked about why this look here makes the market more vulnerable than it was, let's say, up here. If we fast forward to after the close on Friday, April 22nd, you can see we're still in the wide trading range that we talked about in last week's video. And not surprisingly, the longer we move sideways in here, the more vulnerable the longer-term trend gets. This is the slope of the 200-day moving average for the S&P 500 here. You have to keep in mind, this is a possible topping pattern, and we should also keep in mind if it turns out to be a topping pattern and a major top in the S&P 500, then if it's anything like the dot-com bust bear market and or the financial crisis bear market, it's possible we're still in the very, very early stages of a new bearish downtrend. You can see the topping pattern look here where my cursor is, price, 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 price. You can see price was rejected near the cluster of moving averages here, and the slopes of the moving averages look like they're trying to roll over with price below them now. If we look at the major topping pattern here, the S&P 500 peaks in March of the year 2000. Here's this similar look to where we are in the present day. See, price is below the moving averages. They're rolling over here where my cursor is. We're migrating from a full-bore bullish look to a full-bore bearish look. Price here, we can hit it when we move sideways. It's important to keep in mind, in terms of the S&P 500 and ETFs that are highly correlated to the S&P 500, how bad could things be when the 50-day moving average is right here? If you're a long-term trend follower, this is the type of downtrend that we want to avoid under our system. And from this point up in here, where this line is here, so let's say hypothetically, here's where we are in the present day. It's similar maybe to this area in here. The additional loss after the downtrend was in full force from this point in here, approximately 42%, saying if we do indeed break the range, and we're still clearly in the range, so that's not a prediction in any shape, form, or fashion, under a scenario like this, there'd be plenty of time to manage risk going forward, or plenty of time to raise additional cash. Very, very similar situation over here. Price gets rejected. The moving averages are rolling over after the peak in October of 2007. You can make an argument we're in this general area here somewhere. The additional loss in the S&P 500, the bear market was just getting started. We still had to move from about 1,400 on the S&P 500 down below 700. The additional loss from this general area in here to here, approximately 51%. And we know with 100% certainty, if the present-day market is going to morph into something like this, or if the present-day market is going to morph into something like this, again, we know with 100% certainty, price will not stay in this range. And as we'll discuss later in the video, when the Fed is talking about raising interest rates, and interest rates are on the market's mind, markets can go sideways and be highly volatile for long periods of time. So we have to balance the desire to not get whipsawed or overtrade our account when we're in a range with the desire to avoid extremely large drawdowns in the context of a longer-term downtrend. And even after the declines on Thursday and Friday, the present-day market is still well within that normal and to be expected 4 to 15% drawdown range that we talked about back in January of this year. Here's where we closed on Friday, April 22nd. Here are the three levels that we talked about in last week's video. Quickly, we'll scroll through some of the drawdown charts, drawdowns related to the 25 breadth studies that we covered probably 2 or 3 weeks ago. The probability of those breadth thrusts turning out to be a bullish reversal, a lasting reversal, those probabilities are decreasing. Now we're below these lines here that are based on average and median drawdowns. And again, we have to keep in mind, these are based on bullish outcomes. So now we're starting to drift into higher probability of bearish outcomes. Similar situation with the drawdown chart based on the 7 studies that we covered in the following week. Later in the video, we'll cover a bearish MACD monthly cross signal. This gives you an idea of what the chart looks like. The drawdown chart based on that study as of the close on Friday. These are the hypothetical drawdowns that we covered previously based on American Association of Individual Investors sentiment, still within this window here. We're in the lower end of the range of the hypothetical drawdown chart based on that the market falls 10% in a quarter and then rallies 10% off of the low prior to the end of the quarter. All of these looks speak to higher vulnerabilities from a bearish perspective. How about the typical NASDAQ correction based on this data set? You can see how much things change. This is during the session around lunchtime on Thursday, April 21st. Here's price here. NASDAQ Composite still in the range here, but starting to lose some of these reference points. You can pause your video player here. If you're looking for something in the present day that looks significantly different from the topping process in 2000 and 2008, here's one example here. Probably fair to say a few weeks ago this is an improving look. Now it's starting to morph back into a concerning look, but still indecisive and in this area here. Is it possible that value is finally breaking out versus the S&P 500? Well, the odds are increasing. This is a much, much better look relative to the range here. Value has not broken out yet relative to tech or XLK up here in the upper right-hand corner. Same basic situation here. This was an encouraging look, and now it's starting to flip back towards a concerning look. When someone shows you a chart of total market debt and that it's infinitely rising, that really doesn't tell us anything about risk in the credit markets. We have to look at debt servicing capacity. You can pause your video player here, but it's quite a bit stronger in the present day than it was back here in 2007 and back here around the year 2000. Unlike the S&P 500, the Dow Jones Composite has never really exceeded this October low here, and for the most part remains in a very, very long-term period of sideways consolidation. And we look at the sector weights relative to the S&P 500 down here, that's not really surprising. It's because the Dow Jones Composite has quite a bit less exposure to tech, consumer discretionary, and communication services. And if those trends were to continue, then it's telling us that we should be open to a breakout here, a relative breakout value relative to tech. It may happen, still hasn't happened yet. Here's a look at the NYSE Composite during the session on April 21st. And relative to this trend line, if we fast forward to the close on Friday, April 22nd, no question it looks worse. But if we take a step back, we're still in a trading range here as well. And it's important to note, we're not making any assumptions about whether or not this is going to stay in the trading range. We're just speaking to the current chart, the chart in front of us. Things look dicey here, they look dicey here, they look dicey here, they look dicey here. And in all of those cases, the market held. That doesn't mean it's going to hold again. One thing that's important in this environment, we have to be able to discern when to use what type of tool. This is trend-based here. You have to be careful using trend-based inputs when you're in a wide range. Oscillators work better in a range. So we get to the top of the range, quote-unquote overbought. We try to get down here near the bottom of the range, quote-unquote oversold. And if, and the emphasis is on if, the present-day market morphs into something like this over here, which is clearly a downtrend, then that is when you want to leverage your trend-based indicators. And when you're in a strong trend, either up or down, you want to rely a lot less on oscillators. So right now we have a trend that's weak and for the most part getting weaker, but we're still in a range. Whether or not we stay in that range remains to be seen. These are weekly bars for the S&P 500. This is late last year. This is an outside reversal. What this tells us is this week here, we made a new high above the prior week's high, and then we reversed by the end of the week and closed below, in this case, the low from the previous week. So this speaks to indecisiveness, and then the indecisiveness was resolved in a bearish manner. Have something very, very similar this week. We exceeded last week's weekly high here and then reversed sharply and closed below this closing price here and the low. Also noteworthy, the market was up quite a bit this week. In fact, after Thursday's session, the S&P 500 was still up 1 point for the week. So a lot of the deterioration that we're talking about in this week's video really wasn't in place on Monday, Tuesday, Wednesday, or Thursday, because the week really didn't get settled out until Friday's session. It's the 23-week moving average here. It's hard to make an argument that this is not a concerning rollover look here relative to price. The horizontal lines down here show some reference points. This cluster over here, weekly cluster, is noteworthy as well. Also noteworthy, we get an outside reversal on the weekly chart. We also had an outside reversal day. This is Thursday's session here where my cursor is. And we finished the 60-minute chart at the end of the week. We tried to rally here in the last hour of trading. We exceeded the high from the prior hour. And then the bears took over again, and we closed below the low of the prior hour. None of this predicts anything, but it's very, very hard to make the argument that this is a good look for the bulls. This is a good look for the bulls, or this is a good look for the bulls. It speaks to increasing bearish probabilities, with the emphasis being on the term probability. You may remember in a past video when we were rallying off these lows, we mentioned these were some reference points up here. You can see the market. It's not unusual to exceed them. Everybody buys in here and then the market reverses. So we should also keep in mind that it's not rare when we're looking at some reference points at the bottom of the range for the same thing to happen. And it did happen here. When you're in this general area here, a lot of people had the October low as a reference point, and maybe even this cluster over here. So we have to be aware of where the stops are, and we could get a false breakdown and another reversal. Noteworthy, there's a gap here in the S&P 500, which is approximately 16.5% from this peak up here. So if you come back here, your drawdown ends up being about 16.5%. I think we probably covered this in the past. This research here is from LPL Research. The average and median drawdown in a midterm year is right around this number here. That would be the bad news. The good news is a year later after these drawdowns, really, really good things typically happen. The S&P 500 typically rallies in the next year about 32, 33%. We took that out to 2 years over here. The average gain, somewhere in the neighborhood of 45 to 50% after the intra-year pullback during the midterm years. Once again, doesn't predict anything, and this is simply a reference point. We're not saying price is even going to get down here, but if it does, it's good to know that it's there. 3 weeks ago, it looked like the weekly chart was going to try to get back above the moving averages here. This is a concerning look. You can pause your video player and look at some of the other examples here, 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 and here. Again, doesn't mean we're going to fall here, but the odds are deteriorating, and our allocations take that into account. Not an encouraging look. Small cap ETF back below this gap here. Reference point here. This is small caps relative to TLT. Not a good look here. This is small cap growth relative to IEF. Not that it's particularly important, but from a symmetry perspective, the potential inverse head and shoulders pattern on the triple Qs has really been negated over the last two sessions. That would be the bad news from a probability perspective, but you can see here and here, still in the range. That would be one potential positive. This isn't a good look here, nor is this a good look. Dow Industrials, resistance here, support here, still in a very, very long-term range. Somewhat of a risk-on, risk-off look in an indecisive area here. If you're a stock market bull, you want to get back into this area up here. If you're a bear, you want to move into this area here. It's very, very easy to look at price up close in the last two sessions and say we're doomed, but we have chart after chart, including the S&P 500 equal weight, that's telling us to keep in mind, for the moment, we're still in ranges for the most part. Now let's shift gears and talk a little bit about inflation, the Fed, and recession odds. This is text from a Wall Street Journal article dated April 12th of 2022. Last CPI report on an annual basis saw prices increase by 8.5%. So when the next report is released, market participants will be saying, is it better, worse, or about the same? The key text is on the bottom portion of your screen. The year-over-year comparisons are about to start getting less severe. The big move up in inflation began last April, when core prices rose 0.9% from a month earlier. Next month, that gain will no longer be part of the year-over-year equation. Thus, even if core prices register the same monthly gain in April as they did in March, their year-over-year gain will slip to 5.9%. So once again, even if inflation month over month rises at the same rate it did last month, the annual number would drop from 8.5% to 5.9%. The Federal Reserve Bank of Atlanta breaks CPI into two major components: flexible CPI and what they call sticky CPI. An example of flexible CPI would be gasoline prices, something that would tend to be more sticky or hard to change once price increases would be automobile insurance. The good news is sticky CPI was only up 4.7% year over year, relative to flexible CPI that was up 20%. And ultimately, whether or not inflation is going to calm down sometime between now and the end of the year really sets the stage for 10-year yields or interest rates, and maybe more importantly, whether or not the Fed is dovish or hawkish as the year progresses. And said more accurately, we're really trying to discern whether the Fed is more hawkish or slightly more dovish. It's all relative. As of the close on Thursday, April 21st, no sign of interest rates calming down in any shape, form, or fashion. And if, and the key term is if, inflation data starts to cool a bit or becomes less bad in the second half of the year, then it's possible on this monthly chart, some of these areas in here, this level here, this trend line that dates back to the early 1980s, if inflation can cool a little bit or become less worse, it's also possible that interest rates will calm down. And ultimately, what the Fed has been doing is jawboning rates higher in recent months. And that's by design. They really want the market to do the work for them, and then they can come in behind the market and raise rates. And another potentially positive development is that 10-year real yields got above zero for the first time recently, which is something that the Fed wants to see. In terms of recession probabilities, we really haven't seen anything other than extremely strong economic data. April 21st, the most recent labor data, very strong. LEIs, or leading economic indicators, came out on April 21st. They rose in March. This Reuters article on the right side of your screen cites two periods where the Fed was raising rates in a very rapid fashion to try to get back to neutral. Mid-2004 and late 1993. In 2004, the Fed raised rates 5 times. In 1994, there were 6 increases in the federal funds rate. Upper right-hand corner of your screen is the S&P 500 between 1993 and the end of 1994. Chart in the lower right-hand corner of your screen begins in June of 2003 and goes to year-end 2004. In both cases, the S&P 500 peaked relatively early in the year, in years that were marked by multiple Fed rate increases. Q1 here in 1994, Q1 in 2004. In each case, from that point A, the drawdown from the intraday high to the intraday low in both cases was fairly significant. 9.73% in the 1994 case and 8.81% in the 2004 case. In the 94 case, the low was made on April 4th for the year here. In the 2004 case, you can see the market was extremely volatile and didn't make its lowest low until August. In both cases, the markets rallied off of that low. In the 2004 case, it rallied 14.25% from this point B down here to, let's say, this point C up here. In the 2004 case, from this point A here, this is where the correction begins, the drawdown 8.81% to point B. This figure here, 4.19%, that's the difference between point A and point C. Similar situation here. The 9.73% is from this peak at point A to this low here, intraday low at point B. This figure here, point C, at the end of the year ends up 4.88% below point A. From a full year perspective, here's January 1st, 1994, and here's year end. The market lost 1.54% for the full year. In the 2004 case, here's January 1st in this area here. Here's year end. The market ended up gaining 8.99%. Moral of the story here. In both cases, a ton of volatility during the calendar year, but at the end of the year, it really didn't look that bad. Telling us that if we stay on this type of script, we want to try to be as patient as possible with trading. And as patient as possible means we respect that we may get off of this type of script and we could morph into a significant bear market script. So based on the data in front of us, we're trying to balance the desire not to get whipsawed into oblivion with the need to protect capital in a significant drawdown scenario. So let's take a look at some trend reference points and see what we can learn. These are the same periods in the same charts. We've now put a 50-day simple moving average in blue, the 200-day simple moving average in red, and the simple 250-day moving average in gray. Given what we've seen year to date, probably fair to say the present day looks more like the 1994 case. And if we compare the look of the chart in the first half of 1994 in this general area here to the present day, so this is June of 2021 on the bottom here. This is the present day, April 21st on the right-hand side. There's nothing magical about 1994, but in both of these cases, 1994 and 2004, we had multiple Fed rate hikes. We had a fairly significant drawdown in both cases, and we had a ton of indecisiveness and volatility. Probably fair to say this area in here doesn't look significantly different relative to the present day. In both cases, we've been moving above and below the moving averages, but for the most part, the uptrend remains intact. In the 1994 case, this intraday low here was approximately 5% below the 250-day moving average. In the present day, thus far, we've gotten 5.98% below the 250-day moving average. How is this helpful? The more the present day on the bottom of the screen aligns with the script up here, the easier it is to try to ride things out. Conversely, if the present day starts to drift significantly from this look here, then bearish probabilities would start to increase. And if you know your stock market history, you know in both of these cases, if you are able to navigate to the point B out here at the end of the year, the reward after the multiple Fed rate hikes and the reward after all of the gut-wrenching volatility was significant. In the 1994 case, here's the end of the year here. So this is the period here that we've been looking at. Here's the period here in 2003, 2004 that we've been looking at. This is the end of the year here, 1994. The gain from this point A to this point B up here, 232%. The magnitude, quite a bit weaker in this case, but still very, very satisfying. From year-end 2004, after all of the volatility in here when the Fed was hiking rates, the S&P 500 tacked on an additional 29.15%, simply telling us to keep an open mind about better-than-expected outcomes. It also tells us what really we've been talking about since January. Wild swings in the stock market and wild swings in asset class leadership are really to be expected when interest rates are part of the equation. Now, as we said in both of these periods, we had a relatively peak-to-trough muted drawdown, approximately 10% in 1994 and approximately 9% in 2004. And in both of these instances, despite multiple Fed rate hikes, the economy avoided a recession. Thus, it might be helpful in the present day to look at some key economic data. Housing starts really doesn't look recessionary at this point. Is it possible that this data will start to decline or get weaker in the months ahead? Sure, it's possible, but right now, it still looks very, very strong. In all of these charts, recessions are shown via the shaded areas. This is a different way to look at stress in the financial system. It comes from the St. Louis Fed. Similar to the Chicago Fed's National Financial Conditions Index, the stress index is designed for normal conditions to be roughly at zero, right where this horizontal line is down here. Values below zero suggest below average financial market stress. Well, we're well below zero in the present day here, and well below this stressful reading here in 2020. We don't look anything like this huge spike here during the financial crisis and this peak here in 2008. And as we've said many, many times, yes, this can change very, very quickly. It hasn't changed yet, and there's really a lot of bad news already baked into the cake. As always, we'll keep an open mind about what this is going to look like in the weeks and months ahead, but right now, it's very, very difficult to say that it looks anything other than very good. Same basic read with credit spreads. Present day down here, 2020 up here, 2008 way up here, 2001 here, dot-com bust bear market, really doesn't look anything like 2022. Present day industrial production figures, incredibly strong, making new highs. Obviously, if any of this data starts to deteriorate, then recession odds or concerns about a recession would start to increase. And that may happen very, very soon. But in every case, it hasn't happened yet. And that tells us we should be open to something like the 1994 case and something like the 2004 case, where the market is extremely volatile, but for the most part, stays within a range and doesn't drift too far from these trend reference points. Now let's shift gears to some new studies and see how they can help us. This is the Consumer Discretionary Bullish Percent Index. We're looking at all of the data that we have going back to 1996. It's rare for the Bullish Percent Index to move from the red line down here to the green line up here. In fact, it's only happened 3 previous times in the last 26 years. In each of those cases, really, really good things happen looking out 1 month, 3 months, 6 months, 9 months, 1 year, and 2 years. 1 year later, the average gain was 40%. 2 years later, a hair under 62%. And in all 3 cases, drawdowns after the date of the signal, relatively muted. Average drawdown about 1.25% in the S&P 500 index looking out 1 year. Median, a hair over 1% as well. If we put these figures here on a 2022 chart of the S&P 500 as of the close on April 21st, tells us that if the market drops below these levels here, which are the hypothetical drawdowns based on the historical drawdowns, the further we move away from these lines and the longer we stay below them, the lower the probability that we're staying on the better than expected outcome script based on something that just happened in 2022. And remember last week we talked about the inverse head and shoulders pattern with the upward sloping neckline, and it's a possible inverse head and shoulders pattern because it's not fully formed yet, and we don't have a breakout above the hypothetical neckline here. But we are holding here based on closing prices thus far over here relative to the potential left shoulder. This would be your potential right shoulder. On an intraday basis, came down to this line here. Thus, this is as of Thursday's close. Possible we could see something like that and still have the pattern, possible pattern, remain intact. Really, what's more important is the range here. It's a chart we've covered in recent weeks is the Dow Jones Corporate Bond Index. It's a weekly chart going back to 1997. This is the 200-week moving average in red. Down here, we have a 15-week rate of change. It's pretty rare to see corporate bonds get drilled as they've been drilled in recent weeks and recent months. In fact, going back to 1997, using all the data that we have, it's only happened 2 previous times. At this point here in October of 2008, and this point here in 2020. And in those 2 cases, the shorter-term outcomes were in stark contrast to each other. In one case, you had significant drawdowns, October 17th, 2008. The second case, March 20th of 2020, is near that March 23rd major low after the COVID plunge. And as you might imagine, the max 1-year drawdown from the date of the signal significantly different in the 2 cases. This is the MSCI World Index X United States. Think foreign stocks. In this case, we're looking at a monthly chart going back to 2005. Get a bearish cross here in October of 2007. Get a cross here in 2011, 2014, 2018, 2020, and we have one in the present day. You know your market history, those are relatively concerning periods. In the present day, the monthly cross came at the end of February, or February 28th of 2022. This chart only goes back to 2005, but we have data going back to 1998, and there were 6 similar cases. Once again, the outcomes were significantly different. Recessionary period here, dot-com bust. Recessionary period here, the financial crisis. In some of the cases, the maximum 1-year drawdown, really not too bad, 4.41%, 5.57, 2.85. Not the case here, 48.76, and in this case, 23.59 was the additional pain in the S&P 500 index. So these drawdowns can help us draw some lines in the sand. These lines in the sand here would be, we're still on the possibility of a better than expected outcome type script. These ones would definitely be worse than expected. So let's focus on the better than expected or more muted cases, and let's put these drawdowns on a 2022 chart. So if we can hold these levels here from a probability perspective, good things could happen. If we drop below these levels, you can see things could get significantly worse, and they could even get significantly worse relative to this level here. So from a probability standpoint, we'll learn something relative to these areas in here. If we hold them, that's a good thing. If we drop below them, bearish probabilities start to increase. You pause your video player here, still holding on to this favorable look. So this move here looks similar to these blue vertical lines where good things happen in the S&P 500. If the right side of this chart here starts to look more like this, that's not really a good sign. We trade the chart in front of us, and right now the look of the VIX, there's nothing really encouraging here. The VIX held here. This is early January, late December. Bad things happened in the S&P 500, trying to make a stand in a similar area. We also have an outside reversal. This is a fear reversal in favor of fear of increasing volatility on the weekly VIX. RSI back above 50. Nothing magical about these levels here, but if you're trying to stay in this range for SMH, the probability of doing that has dropped. We lost this level, and this level. Still some possible support in this cluster here. From our perspective, SMH has been weaker than the market recently, and it has also been weaker than XLK. This is what a confident breath thrust looks like. We really don't have a confident look over here. Still holding this line, but looking very, very vulnerable. For now, XLK divided by SPY is still holding the upward sloping trend channel. Really, everything that we've seen says the odds favor XLK SPY getting into this area here. It may happen soon, but it hasn't happened yet. It's possible in the coming days or coming weeks the market will answer the million-dollar question. Are we still range-bound, or are we going into a longer-term bearish downtrend? We have to be careful that we don't look at things too close. Up close is important. This is very, very relevant. But if you take a step back and look at a weekly version of this chart, it's not unusual for these type of spikes to be relatively short-lived and for them to occur near lows in the S&P 500. Here's a spike here, a spike here. The market rights itself relatively soon. Not a prediction about any of this. This is definitely a negative, but we have to think about the context as well. It was the S&P 500 with the 8-day, the 12-day, the 20-day, the 50-day, and the 200-day. There's really not a lot of encouraging things to say about this look here. So this is the chart in front of us now. It doesn't tell us what this chart's going to look like. The chart didn't look good down here either, and it reversed. But the chart in front of us unquestionably looks worse here than it did even right here. All of that speaks to probabilities, and we're assessing probabilities on multiple time frames. You can see we're in a very, very important area here. At this point, price is above all of the moving averages. Now we're below all of them, and you can see the slopes look like they're trying to roll over. Still in the range. So this gives you somewhat of a deteriorating trend look. And then if we were to look at our oscillators, we're still in the wide range for now. And if we break that range, the longer we stay below it and the more we start to morph into a look like this, the more concerning it becomes. Just as you're incrementally taking some defensive action in here, the incremental defensive action would probably occur at a much faster rate with a look like this or a look like this. But it really is in the context of the weight of the evidence. Nothing is really absolute. We'll see how it plays out, and we'll see what the data looks like. As we mentioned in a past video, typically something has to improve for the market to improve. We really don't have any improvement on any of these bullet points yet. It's not all one-sided. We have numerous signals that tell us to keep an open mind about better than expected outcomes. A lot of sentiment is starting to get very, very extended in the bearish direction. And for the most part, the economic data has been very, very strong and is not screaming imminent recession. Prior to all of this, the longer-term trend in the stock market was unequivocally up. The intermediate-term trend, for the most part, is in a range, so indecisive. No one's really winning that battle in a range. The shorter-term trend is still vulnerable. Nothing is binary, nothing works all the time. If you leave a range, it doesn't mean you can't go back into the range. Weight of the evidence approach. Overshoots are very, very common. Everybody tends to put their stops in the same area. And thus, sometimes after all of those stops execute, reversals can be sudden and sharp. And with a look like this, somewhat of a mixed package, is more important than ever to head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.